Treatment of preliminary expenses. A company is a person brought to life by the law of the country. And in the process of bringing a company to life, real people invest their time and money. It means the company, when it finally comes to existence, is already in debt to these people for the money they spent. These expenses are really extraordinary in nature because these happen only once in the lifetime of a company. Let's see what the Companies Act 2013 and the Income Tax Act 1961 say about the accounting treatment of preliminary expenses. What are preliminary expenses? Click here to know. Before we get into the matter, let's rule out the fact that the preliminary expenses will result to obtain any physical value or become a tangible asset. The Companies Act 2013. The companies have to show the entire amount of such preliminary expenses in the debit side of the balance sheet as fictitious assets and amortize it in 5 equal installments over the period of 5 years. It means that two things happen here. First, the entire amount is credited to the profit and loss account and shown at the debit side of the balance sheet for say rupees 20,000. Next, a sum of rupees 4,000 each year will be allowed to be deducted as a debit to the profit and loss account for 5 consecutive years. The Income Tax Act 1961. The treatment is same in the case of the Income Tax Act 1961, with the slight twist, however, that the preliminary expenses cannot exceed 5% of the total capital employed. In the previous example, if the total capital employed was rupees 2 lakhs, then only rupees 10,000 would be allowed as preliminary expenses. Thus, rupees 2,000 would be amortized every year for 5 years. If you have any queries, please comment. Thank you.